All right, Nick, it's your show today.
Yeah, thank you. Maybe turn the tables a bit here and
All right.
put the questions in my hand. So I'm happy to be here with you as always, Paul. And I think this is an opportune time to talk about the first quarter market environment. I mean, no one has done more home services and pest control transactions than you, and you're out talking to buyers all of the time, both on the private equity and strategic side.
Yep.
So I'm just curious to open it up to you, and what are you seeing out there?
You know, it really is a financial sponsor dominated market. So when I use the term financial sponsor, it's another term for private equity firm. And yeah, I mean, look, almost, if I think about 2023, 90% of our transactions with private equity firms, whereas 5 years ago, it was the exact opposite. It was 90% with strategic acquirers. So the landscape has changed dramatically. And, you know, here in Q1, one of the things that's really interesting to me, and I was just talking to the Mexican about this the other day, is 3 of the transactions we're working on right now are transactions that began with financial sponsors that approached sellers directly. So as we all know, there's a million buy-side brokers out there sending emails to everyone. Every private equity firm is sending emails, calling offices, saying, hey, do a deal with me. And what ends up happening is, you know, a seller's not really thinking about selling, gets a phone call, says, you know, what's the big deal? I'll take the dinner. And then has the dinner, and then next thing you know, trade some numbers back and forth, and then all of a sudden now they're in an LOI, and then
the charm offensive takes place within that process. I imagine it's pretty overwhelming for some sellers.
Yeah, the sellers are like, you know, the private equity firms are like, hey, no reason to talk to anyone else. Do a deal with us. We're extremely competitive. Why breach confidentiality and run a process? We're going to take care of you, and here's why we're a great shop. And then, you know, the seller gets into exclusivity, and then on these 3 particular transactions, over the last 90 days, I received phone calls, and they were almost virtually the same. Like, hey, Paul, I'm in DD with XYZ private equity firm, and I just wanted to, like, it's starting to get real, and I just wanted to talk to you a little bit about what you might think about the deal. And, you know, this one that I was just dealing with this morning was, guy called me up and said, hey, you know, here's the fundamentals of my business. Here's what the offer is. Before I finally pull the trigger, I want to make sure that, like, am I getting an awesome deal or am I getting screwed? And I don't know. And I listened to what he had to say, and I'm just like, you're easily leaving $5 or $6 million on the table. He's like, you don't, this isn't a great price. I'm like, no, it's a great price, but you can do a lot better. If you're happy with that, go ahead and go forward. And then inevitably, these deals fall apart. And so I always tell sellers, first off, don't go into a sale process, particularly if you're going to do a substantial change of control transaction without running a full process. Sure. I mean, look, any of the private equity firms that you're dealing with, they wouldn't sell assets that way. So why should you? Right? If you should follow what these guys are doing. They hire bankers, they run control processes, they sell to the highest bidder. Follow that, right? That's good. It's good modeling.
Especially when you get to do it once in your life, typically, right? And they're doing it all the time, and they're still running that process.
Yeah, and then, you know, it's not just the price. You know, I look at, you know, a lot of the terms of the transaction. You know, a lot of these private equity firms. You know, by the way, I don't blame the private equity firms. This is exactly what they have a duty to do this. You need to go out, you're a private equity firm, you want to get proprietary deal flow that's not shopped. You don't want any competition. And then you want the ability to get creative with preferred equity structures to protect your returns and protect the returns of your investors. So just like if you own a private pest control business and you want to go out and do deals, you need to, quote unquote, take advantage of sellers. That's what you have to do in order to get a return. And it's not really I shouldn't even use the term take advantage of them, but there's clearly informational asymmetry, right? And you need to, that's how you get your returns, by buying right. The majority of the returns of a deal are locked in stone when you enter. So It's interesting though, because now we're starting to see sellers wake up to a certain degree, specifically the ones that have gone out there and tried to do it on their own, to say like, am I getting a good deal? And it's impossible. Like, I try to put myself in the shoes of, let's say that I owned a business like a medical device company, which I don't know anything about medical devices, but if I owned a medical device company, how the hell would I, even though I am toiling in the M&A vineyards every day of the week and I've done it for 20 years, how would I really know if I'm getting a good deal? I wouldn't know. I don't know anything about the space. I don't know what precedent deals look like. So I can only imagine if I wasn't an investment banker and I was an actual operator, like how much less I would know and even understand about the fundamental valuation dynamics in that market. So that's largely what we're seeing going on. I mean, I scratch my head at the consolidation that continues to take place in the resi and commercial services space. And we've clearly seen a tick up in yields over the last 24 months.
Yeah.
And one of my questions I'm going to kick back to you is that sellers are constantly focused on financing costs and interest rates. And they think that sort of like entirely drives valuations in the market. And to a certain extent, that is true. I look around and when I start to plan for the future and I look at kind of global macro as well as US macro, we just had Powell come out last week, right? FOMC, had the March meeting, and he has kind of changed his tune now dovish, right? And clearly, when you look at inflation data, certainly in 2023, we had trailing off inflation, but inflation data in Q1 here has not been the Federal Reserve's friend. And so I have to start to wonder how much of this is related to the fact that the Fed is boxed into a position where they're going to ultimately have to loosen financial conditions solely because the deficit and the debt is otherwise unfundable. Like, at what point does the Fed just say, okay, we have to sacrifice the currency because there has to be a release valve somewhere?
Sure.
And then what the hell does that mean for asset prices once again?
Yeah.
Well, what's your thoughts on this?
It's a good question. I came into the year thinking that predictably, as usual, the Federal Reserve is going to be wrong because, as you know from following markets for 25 plus years, give me a time when they've been right. Okay. And so they came into the year thinking we're going to have this very nice glide path of 3 interest rate cuts. And my view is that inflation is either going to be stickier, the economy is going to be better, and they might not have any cuts, right? Despite really turning dovish in December. And then we've had the subsequent risk asset rally since that time. So I thought that was one plausible scenario. The second plausible scenario would be things weaken much faster than everyone's thinking, and then they need to cut much more aggressively, maybe 200 basis points of cuts, okay? And so it seems at this juncture, we're on the first path, which is stronger economy, inflation staying sticky, energy assets, or the price of oil continues to rise throughout this year, which clearly isn't going to help these disinflationary trends. And so, as we look towards the future, I think what the Fed is ultimately grappling with is what's the neutral rate for interest rates, okay? To your point, the Fed or the Treasury has been financing the government with short-term T-bills as opposed to longer-term duration bonds like 5, 10, 30-year, et cetera. And so having rates that high at the short end of the curve, what the Fed controls, becomes very problematic for the financing costs. Okay. And so when you think about the neutral rate, what that means is like, what's the neutral Fed funds rate to where the economy is growing, inflation is not too hot, not too cold in a sense to cause disinflationary, deflationary trends. And the jury's out because I don't think inflation is going back to 1.5%, 2% that we experienced over the past 15 years. I think 2.5%, 3%, 3.5% is much more likely, in which case the neutral rate's higher than people think. Okay, so that's some of the way that I'm contextualizing it. But I think longer term, the secular forces would suggest that we're going to have much higher inflation long term over the next, let's say, 7 to 15 years, which that just argues for higher
Just
interest
because we're going to
rates.
have to liquidate the debt. We're going to have to monetize that debt.
Yeah, and again, like we've talked about this, government, when you have this type of government debt, 120, 130%, wherever we are right now, like tightening your belt is not something that governments do. Like populations of politicians cannot take deflationary pain and debt defaults and tightening their belt on their lifestyle. So the only other solution is to inflate the debt away. And that's what we've seen time and time again, not just in the US, but in other markets. Emerging markets are particularly noted for that type of behavior. And so what that leads me to believe is run inflation a bit hotter, right? Have some sort of financial repression in order to inflate the debt away.
What do you think that looks like?
We need to hold on a second, because I feel like the microphone's been turned around now. I want to get back to the M&A market. Okay.
Well, I was going to get to that.
Okay.
So what do you think that looks like from an asset price perspective? You know, when I'm always thinking about things in the context of M&A and valuations.
Yeah.
So obviously this is a core part of that.
Yeah.
And so when I start to think about, you know, I'm in a business that's really hard to plan from a resource allocation perspective.
Yeah.
How much manpower, you know, that's why like investment banks are constantly in times of feast, hiring all sorts of people, and then famine, like getting rid of everyone. And I don't like to do that.
Sounds like the Federal Reserve.
Exactly.
They just
right.
hire.
They just hire. So I need to, you know, we try to plan internally, and we start to think about like, what does M&A volume look like? And M&A volume is directly correlated to asset prices. And so when I start to think about over the next 12 months, I mean, where do you think this could go? Mm-hmm. Do you feel like we're going to continue to see frothy markets at the end of this year?
My inclination is yes. Okay. So the Fed has very clearly signaled that they're going to ease financial conditions. And just by them talking about it, they've brought that into existence.
Yes.
Okay. And so when I think about back in what I like to call the OG tech bubble, right? Even though probably the Nifty 50 was really the OG tech bubble, but the late 90s tech bubble, you had a 6.2% 10-year treasury yield, and the near-term price to earnings ratio was 26 times, right? Today, the Fed or the 10-year bond is at 4.3%, and the near-term P is 21 times. So clearly, things can become more extended, particularly as the Fed eases financial conditions. So what does that mean for risk assets in general? I think as long as the economy continues to chug along, you know, boosted not only by fiscal support, you know, by the government, but also consumer balance sheets are still quite good. And when the market's at an all-time high, the wealth effect is clearly kicking in, further supporting the economy. So, you know, we have a bifurcated economy between services and goods growing much more quickly than services growing much more quickly than goods, which have essentially been in a recession for the past year. But I think given the easing of financial conditions and how markets follow that, typically, we could see more froth. Not a prediction, because as you know, in the short term, assets can go anywhere. They can be priced anywhere. And we've seen that time and time again. But that would be my overall view of risk assets. Yeah.
And when you think about, I guess the last question I have for you on this topic is when you think about when you're looking at your various different quadrant analysis that you like to do in this market, you're in a time of, would you say, increasing inflationary pressures? Is that accelerated?
I would say throughout last year, and just to take it back a bit further, throughout last year, we had lower inflation relative to expectations and stronger economic growth, really boosted by services and fiscal spending, okay? Q1, it was a continuation of those trends, right? As we move to Q2, I think it's more, and through the back half of the year, I think it's more of either a reflationary environment, meaning growth and inflation are accelerating relative to expectations, or it's potentially worse environment, which is stagflation, where the economy isn't growing quite as fast as people thought, but yet inflation's coming up, right? Like that's the worst, really, for equities and equity assets in general. Okay.
My last question again. This is my second last.
Let me make one more point.
Okay.
I will say though, when I think about those environments, that doesn't mean that, for my client partners, I'm trying to move assets here and there, like in a very short term. But I always like to be cognizant of where we are in that cycle, because on the margin you can make tactical changes, but it's not.
Which is what
it's
I
not
really
wholesale changes.
What I really appreciate. You're looking at this month over month, quarter over quarter to get a sense of where the U.S. economy is headed, as opposed to making daily allocations based upon. I get that.
Yeah.
An important thing for guys like me is really kind of where financing costs are on the longer end of the curve, which, as you know, is the underbelly or underpins a lot of the corporate credit markets. And so that would imply the 10-year. And, I feel like we're almost at this point right now where the bond market, if you watch the auctions, the bond market, particularly on the 10-year, is trying to figure out, like, what's the truth here? Like, we've got a shit ton of debt. We've got the government doubling down, spending more. Fed on the short end is threatening rate cuts, but they don't control the short end of the curve. And so it's the investors ultimately losing faith in the ability of the Fed to control this and the government to actually slow the spending, which we know that they will not do. So at what point do you think we start to get upward pressure on the 10-year?
That's an incredibly difficult
The old
question.
bond vigilante situation, right?
Exactly.
When does that happen?
That's an incredibly difficult question. The way I would think about it is really, we're not likely to know what the result of that is going to be until we actually have a recession. Because what's typically the case in emerging markets is when you have a recession, then the longer end of the yield curve in those emerging markets, the rate can actually go up.
As opposed to what
we've
we
never
see in a
experienced
developed
that.
U.S. economy where the rates fall.
We've never experienced that. And that ultimately speaks to the creditworthiness of the country and also the long-term inflation rate.
Yeah.
So that will be telling, but I think the jury is still out. However, I don't think market participants are prepared for an outcome where the Treasury actually, or the 10-year Treasury interest rate actually goes up. Okay. But what I wanted to ask you is that you talked about this flip of strategic versus financial acquirers relative to 4 or 5 years ago. Could you talk a bit about what do you think the drivers of that are and what that means for the long-term valuations of the industry of home services and pest control specifically, multiples?
Yeah, I mean, that's a great question. I mean, we'll start with the sector that I know the best, which is pest control. And, when you think about who are the strategic acquirers in this space? You had Rentokil and Terminix, which are now one.
Yep.
You have Rollins, anticimex. Those are the big four. And historically, they accounted for 80+% of all transaction volume. I would almost even argue 90% of all transaction volume globally in this space. We have seen, obviously, the merger of Terminix and Rentokil. That's caused Rentokil to focus more on integration and less on acquisition. So that's naturally slowed Rentokil and Terminix down. I mean, the combined entity is still doing deals, but they're much more selective because they don't have any must-haves anymore. There's less white space for them. And now it's like, okay, where can we do an accretive add-on acquisition? Rollins typically does somewhere about 100 million in M&A volume per year. Rollins is the parent company of Orkin. Every 2 or 3 years, they'll do a marquee deal, larger size. But for the most part, run of the mill, 100 million, give or take. A lot of them are smaller deals. So they might do 15, 20 deals equaling 100 million in transaction volume. Anticimex has been, Anticimex attempted to go public in early 21.
Yeah.
I personally feel that Anticimex, the board got probably a little bit greedy. Now, if you think about it, 2021 was crazy, frothy. Everyone was acting batshit crazy. But at the end of the day, they wanted to go public at north of 25 times.
They should have branded themselves as a meme stock.
I could have done it or got ahead of the AI thing, like Anticimex AI.
Yeah.
But so they pulled that deal, and there, of course, Jarl, the CEO, who's well loved by everyone, stepped down. They brought in a new CEO. As financing costs started, if you think about their financing in Sweden, was some of the earliest and most negative interest rate yielding countries on the planet, right? Sweden went negative very early, stayed negative for a very long time, and was very aggressive. And so they had tremendously low financing costs. And then anticimex went out over the years. And of course, EQT owns the business. They brought GIC. They brought a variety of different, very deep-pocketed capital providers around the world. They had a lot of very low-cost money. And so in 2020, 2021, anticimex was extremely aggressive. But now as financing costs have increased, their balance sheet has gotten, I don't want to call it wobbly, but let's just say it's not optimal. And I think the strategics went from 2018, 19, 20, 21, did a ton of deals. And now they're just like, hey, in order to create value, it's better not allocating to new deals. Let's focus on integrating these things. Let's focus on taking things we've had, make them better, and get increased margins.
It's actually impressive because that's a hard pivot to make, especially as a company with public expectations.
You're seeing these guys exert some discipline on their business. I think with regard to the financial sponsors, I mean, it's just the brew of low yields, industry consolidation, COVID. In my space, the majority of what we do is on the resi services side. So whether it's pest control or lawn care or roofing or guttering, when you think about all these resi services businesses, financial sponsors have gotten into it due to the COVID boom. And there's been a lot of noise made in recent years about changing demographics and boomers outsourcing more, and the fact that young kids they don't paint, they don't know how to mow the lawn, like all those sorts of things. So I think from a fundamental, at least from a secular perspective, there's probably a nice tailwind in that space. But, like lemmings, this hot money all jumps in at once. So I think that's really pushed up transaction values. I think it's an area when you think about resi services is extremely fragmented. So what better roll-up play than you got strong secular tailwinds, you've got free money, and then you've got a very, very fragmented space where you can buy a platform business and do a tuck-in acquisition and just rinse and repeat and do that over and over again.
Relatively recession resistant too.
Relatively recession resistant, that works until it doesn't. I think that the strategics have just gotten tired a little bit, gotten more disciplined, and I think it's the financial sponsor game. The question is, how long does this run? Quite frankly, I thought to myself as yields began to spike 2 years ago that we would start to see a slowdown, but it just hasn't happened yet. Now, do I think that some private equity firms have kind of tightened up what they're willing to pay? Sure, I do think that. But at the end of the day, in a very fragmented industry, whatever it is, you have a finite number of platform businesses. Like in Pest, there's 20 or 30, right? In lawn care, there's 10. So you have a small amount of businesses that can actually be platforms. You have an endless runway of tuck-ins. So there's a tremendous amount of competition for those scarce assets, which dramatically drives up the price. But that's what the private equity firms do, and they've got to pay to play to get in now so that they can consolidate in the future. So anyway, I mean, look, I'm optimistic in the rest of 2024. Jury's out really for me after that. Again, we've got an election year. I don't have any conspiracy theories. Everyone likes to talk about Trump and Biden and the Fed, and I don't know.
What's fascinating about what you just described is that there's a massive incongruency between private equity building these businesses, starting with a platform, adding on, and then doing those deals at a certain valuation level, juxtaposed with the strategics who don't want to pay big multiples. These private equity folks, they need an exit.
We shouldn't say that because I think about it every day. When I'm looking at the public guys, and let's say they're trading, rentokil's trading at 12 times EBITDA now? I don't even know.
Around there.
I should know. I just bought more this morning.
Right around,
when they're trading at 12 times, I should not be able to sell a pest control company to a private equity firm for 18. It shouldn't happen. And historically, that hasn't happened. You would always see a discount in the private market versus the public market. Always. At least since I've been around.
That's what makes a roll-up good.
That's what makes it. And so now it just is like, and And it is probably through, juice and returns with leverage and the theory, the private equity theory, and what they will openly say when they sit down, like, I'm a private equity guy, I want to buy your business, Nick. Nick, here's what we're going to do. Yeah, this sucks. I'm going to have to pay you 18 times EBITDA to buy your business, but you're going to partner with me. And then what you and I are going to do together is we're going to go out and we're going to buy that guy for 7 times. We're going to buy that guy for 9 times. And how are we going to do that? We are going to convince him that price is objective. Like, everyone's going to, there's a going rate. Don't worry about talking to anyone else. We are going to whisper sweet nothings into his ear. You're going to wine and dine him. You're going to make him feel super special. You're going to tell him, hey, don't run a process, save money. You could use a lawyer. You don't have to. It might not be a bad idea. So, and then we're going to buy all these things on the cheap, and we're going to make a ton of money together, and we're going to exit 5 years from now, and rentokil is going to pay 20x for our business. You know why? Because we're the best. That's that whole story, and we'll see how it works out. That's what's going on.
So. It's a fascinating environment.
It is. It is.
Yeah. So, and at the same time, what I've observed across the private equity industry in general is that dynamic is playing out, because exits have been very challenging over the past couple of years for not just pest control private equity players, but across a broad swath of industries.
Yeah. You're seeing private equity firms now start to kick into continuation boots, right? And one thing that's really interesting to me is that one acquirer that I actually forgot to discuss is Pestco, which is owned by Thompson Street. We did Pestco's entry act. You're on the other side of the table with Pestco in September 2021, and that was Ken Fox. You met Ken Fox, right?
Yeah. Actually, no, I've never met Ken.
Never met Ken. He's
I've seen your videos.
You've got to talk to Ken. I got to introduce you to Ken. He's a great guy. So that was the entry acquisition, and I think we were on the other side of the table on maybe 10 of the 13 or 14 deals they've done, and they've grown that business from literally $7 million in revenue all the way up to they're doing 100 and change now. But that's a business that, what do you do with it right now? What do you do with it? And so I think, it's a great business. I like the Thompson Street guys a lot. This is not a knock on them. It's just like, okay, you're a $150 million business. You're in a very disparate geography. Rollins is not going to buy you now, and they're especially not going to pay 25 times for that business. So there's a lot of work to be done. And, I love the fact that there's 70 or 80 private equity firms that are dying to get into pest control. But for the benefits of guys like Thompson Street, they got to wish that weren't the case, because it gets very expensive. But I digress.
Yeah. And the firms that you mentioned that are dying to get in, they'll do research, as you know, for 2-3 years leading up to that. It gets funded, and it's at that point you have these associates, analysts leading those deals. Like, do you think they're not going to make deals? No, of course they're going to make deals, right?
Sure.
They have to, they want to, of course, justify, all the work they've done and the brilliant analysis in order to do it.
Nick, it's always a great discussion with you, and I look forward to doing this a couple of times a month with you going forward. I think, having this chat with you really allows me to get out what's going on in the market. So I look forward to continuing this dialogue.
Yeah, as do I. It was fun.
Yeah.
Okay. Yeah.